Welcome back to the deep dive. Today, we're digging into McCormick and Company, specifically their third quarter 2025 results.
Right, the period ending August 31st. And we've gone through the earnings release, the presentation, the 10Q filing. There's the whole stack.
We really have. And our mission really is to understand the flavor trends driving things globally, but also how are things like tariffs and commodity costs hitting their actual profits?
Exactly. It's about that tension between demand and these, well, relentless macroeconomic pressures. And looking at how McCormick's trying to navigate it all.
Okay, let's unpack this right away then. The top line number, total reported net sales grew 2.7%.
Yeah, but the organic growth, stripping out currency and acquisitions, was 1.8%.
And the really interesting part, I think, is how they got that 1.8%. Volume and product mix, that was 1.2%. Pricing was only 0.6%.
And that volume piece is huge for them. They made a point of saying this is the fifth quarter in a row where growth was volume-led.
Right, which means people are actually buying more stuff, not just paying more for the same amount, despite inflation.
Yeah, it suggests their brands, their products, they're still resonating. They're moving units. And that says a lot.
Okay, so volume's the engine, and that seems to flow down to operating income. Adjusted operating income was up 1.8% too, right? Hit almost $294 million.
Correct. Respectable growth there.
But wait, if volume is driving things, why is pricing only adding 0.6%? I mean, does that suggest they don't have much pricing power right now, or maybe they're choosing not to use it?
That's a great question. It absolutely suggests a choice.
Yeah.
Or perhaps a limitation. Maybe they're prioritizing holding on to that volume, which is smart long-term, but it definitely puts pressure somewhere else.
Okay. And where's that pressure showing up?
Well, what's fascinating here is while that operating income looks okay, you go further up the income statement, the gross profit margin. That's where the pain is.
Yeah, I saw that. It contracted significantly.
Yeah.
130 basis points reported.
That's right. And even adjusted, it was down 120 basis points, so 1.2% shaved right off the top. That's a serious hit.
And what's causing that squeeze on the gross margin?
It's like a triple whammy, really. First, commodity costs are way up, the actual spices, the ingredients, just more expensive.
Okay, that makes sense. What else?
Second, tariffs. They specifically called out tariffs having an increased impact since August 1st. So trade policy is directly hitting their cost of goods.
Oof. All right, number 3.
Third is conversion costs. They're spending money now on expanding production capacity for the future, getting factories ready, and those costs hit the current margin.
Wow. So inputs are costing more, trade is costing more, and investing for the future is costing more right now. They're really getting squeezed from all sides.
Pretty much, yeah.
So how are they fighting back? I mean, operating incomes still went up a bit.
Right. Internal execution. They point squarely at their CCI program, Comprehensive Continuous Improvement. It's their big cost-saving efficiency engine.
Ah, the CCI program. So that's offsetting some of these massive headwinds.
Exactly. They credit CCI savings, particularly with keeping SG&A costs, sales, general admin expenses under control. That helped cushion the blow to operating income.
Okay, so without those internal savings, that 1.8% operating income growth, it could have been negative.
Oh, easily. CCI savings and, interestingly, lower performance-based incentive costs were the main offsets, and really shows they're focusing hard on what they can control internally because the external stuff, commodities, tariffs, that's just tough right now.
Okay, that gives us the financial picture. But let's talk flavor. Where's the demand actually coming from? Who's buying? They split their business, right? Consumer and flavor solutions.
Yep. Consumers, us buying spices, hot sauce, those recipe mixes at the grocery store. Flavor solutions is the big B2B side, supplying restaurant chains, other food companies.
Got it. So how did the consumer segment do? Here's where it gets really interesting.
Consumer was actually the stronger segment this quarter. Organic sales growth was 2.6%.
Okay, 2.6%. And how did that break down geographically?
Well, the Americas were pretty solid, 2.7% organic growth there, driven by good volume, good mix across their main categories.
And Europe, Middle East, Africa, EMEA.
EMEA reported this, like eye-popping 11.4% growth. Huge number.
Wow, okay.
But, and this is a big, but about 7% of that was just favorable currency exchange rates. The actual organic growth, what they sold, was 4.4%.
Oh, okay. Still decent growth, but that currency impact really inflated the headline. Good reminder to always look at organic.
Always. And then you look at Asia Pacific, APAC, that was weaker. Organic sales down 0.8%.
Down? Why?
They said it was unfavorable volume and mix, and specifically called out lower sales to food service customers in China. So maybe that consumer rebound isn't quite hitting all channels yet over there.
Interesting. And within the consumer segment, any specific products standing out, good or bad?
Yeah, they mentioned some pressure on recipe mixes in the Americas, particularly the Mexican flavors. That's one to watch.
Wonder why that is. People making fewer tacos or switching brands.
Hard to say just from this. But on the flip side, their heat platform, basically hot sauce, was doing really well. They talked about gaining market share and getting into more stores.
So people might be cutting back on some things, but they still want their hot sauce.
Seems like it. Got to have that spice.
Okay, let's switch gears to the other side. Flavor Solutions, the B2B business. How did that perform?
Uh, Much slower. Organic sales growth was only 0.6%.
Just point 0.6. Wow.
And crucially, that small growth was entirely price-led. Pricing added 0.9%, which means volume and mix actually declined by 0.3%.
Negative volume on the B2B side, what does that tell you? Suggests maybe their big industrial customers are pulling back.
That's exactly what it suggests. And you see that playing out regionally, especially in the West.
How so?
In the Americas, Flavor Solutions volume was down. They cited weaker foot traffic hitting their branded food service clients, think restaurants, and also lower sales to packaged food companies. Price hikes were the only reason they eked out that 0.9% organic growth.
Okay, so restaurants and food makers in the Americas are feeling it. What about EMEA?
Even tougher over there for Flavor Solutions. A significant organic decline of 3.1%. Lower volume again, and even some unfavorable pricing given to packaged food customers. Those guys must be under enormous pressure.
Man, so weakness in the West for Flavor Solutions. But what about Asia? Was it the same story?
Nope. Complete opposite. APAC Flavor Solutions was the bright spot, absolutely crushed it. 6.3% organic growth.
6.3. How?
Driven by a huge volume and mix increase up 9.0%.
9% volume increase. Where did that come from?
Primarily China and Southeast Asia. Specifically quick service restaurants, QSRs, fast food chains.
So maybe consumers in Asia are cutting back on some grocery items, hurting the consumer segment there, but they're still going out for fast food.
That seems to be the story. Even if the economy is a bit shaky, that affordable convenience from QSRs is still a priority. It really shows that split recovery we sometimes see in Asia.
That regional variation is fascinating. It really highlights why just cutting costs isn't enough, right? They need growth drivers, too, especially with those margins getting squeezed, which brings us to strategic moves, acquisitions and stuff.
Exactly. They need to secure future growth and maybe control costs upstream. They finalized an acquisition back in Q2, Gerardo Inc.
Gerardo. What do they do?
They're a chili mash supplier based in New Mexico. McCormick bought them for about $38 million. It's now part of the consumer segment.
Chili mash. So securing key ingredients seems like a smart defensive move given all the supply chain craziness.
I think so too. With climate issues, geopolitical risks, controlling your core ingredients like chili seems, well, essential. It signals a push towards more vertical integration.
And speaking of big strategic moves, there's the Mexico deal. That sounds huge.
Oh, it is. If we connect this to the bigger picture.
Yeah.
They signed a deal to buy another 25% of McCormick de Mexico. They already own 50% with a partner.
So this takes them to 75% control.
Exactly. For a hefty price tag, $750 million. It's expected to close early next fiscal year, so early 2026.
And the rationale there, just doubling down on Mexico?
Pretty much. They see huge growth potential in Mexico. They sell mayonnaise, mustard, spices, lots of stuff there. And having majority control gives them a stronger platform to expand further into Latin America. It's a big bet on that region.
Okay, makes sense strategically. Now, let's look ahead. How did all this translate into their forecast for the rest of 2025? Did they update guidance?
They did. They tightened the range for adjusted earnings per share. Now expecting $3 to $3.05 for the full year.
And what does that mean in terms of growth?
It represents about 4 to 6% growth on a constant currency basis, so still growing earnings despite the pressures.
And operating income?
Projected to be up 3 to 5%, again, constant currency.
So they're managing to grow the bottom line somewhat, and are they reinvesting those CCI savings we talked about?
Yes, that's part of the plan. Guidance includes a mid-single-digit increase in spending on brand marketing and digital investments, so using efficiency gains to try and fuel more top-line growth.
Smart. But the outlook isn't all rosy, right? There must be some specific headwinds baked into that guidance.
Definitely. They flagged a couple of things. First, they expect around $20 million in special charges. That's mostly costs related to streamlining the organization, integration. Basically, the cost of running CCI and making these changes.
Okay, cost of doing business efficiently. What else?
Second, and this is important, income from their unconsolidated operations, which is mainly that McCormick de Mexico joint venture right now, is expected to be down high single digits.
Down. But you just said Mexico is a growth engine.
Right, the underlying business there is likely strong, but this is purely a currency translation issue. The Mexican peso has been unfavorable against the US dollar, so when they translate those pesos back into dollars for reporting, it looks like a decline, even if the local business is doing fine.
Ah, the joys of global currency fluctuations. Anything else, Major?
Tariffs, the big unknown. They explicitly stated the guidance only accounts for tariffs that are currently in place.
Meaning, if new tariffs get imposed or things escalate.
Then this guidance could be at risk. They haven't factored in any potential new U.S. import tariffs or retaliatory actions for the rest of the year. That uncertainty is definitely hanging over them.
Creates a real challenge, doesn't it? Trying to forecast when trade policy is so volatile.
A tremendous headwind.
Yeah.
It just reinforces that core challenge, turning that solid volume growth, that brand strength, into clean profit growth when the external environment keeps throwing curveballs.
So what does this all mean for you, the listener? Let's try and synthesize this.
Okay, the story from McCormick this quarter, I think, is really about strong internal execution battling some pretty fierce external headwinds.
Right. They're successfully driving volume growth, that's 5 quarters now, and they're managing costs really tightly through things like that CCI program. That internal focus is delivering decent operating income growth.
hmm But that success is getting partly masked, or maybe dampened, by those external factors. Commodity inflation is biting hard. Tariffs are hurting. Currency swings, like with the peso, create noise. And those investments in future capacity also hit the current bottom line, especially that gross margin.
Yeah, the gross margin contraction is stark. They're basically having to run incredibly fast on cost savings just to stand still or edge slightly forward against inflation and tariffs. It's like a high-stakes race between their own efficiency efforts and these broader market forces.
Well put. Efficiency versus inflation.
Which leads us nicely into a final thought. McCormick's entire business, everything they do, depends on getting raw ingredients reliably and, affordably.
Absolutely. They listed some key ones in the materials: dairy, pepper, onion, garlic, capsicums, which are chilies, tomatoes, sugar, salts, the very basics of flavor.
And these things are incredibly vulnerable, right, to weather, as we see with climate change, to global market speculation, to geopolitical conflicts disrupting trade routes or production.
Exactly. They mention all those risks: weather, market conditions, global conflicts, and it really makes you wonder,
Yeah.
well, just how sustainable is this model when the very foundation, the global sourcing of these core flavors, seems to be getting more volatile every year? Can even the best internal cost control programs like CCI truly keep pace if the supply chain itself becomes increasingly chaotic due to climate impacts or ongoing trade wars? That feels like the multi-billion-dollar question for them and really for the whole industry going forward.